In 1985, more banks failed in America than in any year since the Great Depression. 300,000 farms were gone by the end of the decade. Iowa lost nearly a quarter of its farmers. White crosses were planted on courthouse lawns, one for every farm lost in the county. Historians have studied the crisis for 40 years. Economists have written thousands of pages on what went wrong, and almost all of them agree on one thing. Most of it was preventable. Not the drought, not the Soviet grain embargo, not the Federal Reserve raising interest rates. Those things happened, but the damage they caused, the foreclosures, the failures, the families driven off land, their grandparents had broken with their hands. That damage was made worse by one thing that almost no one was doing. One test. Not complicated, not expensive. A test that existed. A test that worked. A test that told you exactly how much danger you were in before the bank sent the letter, and almost nobody was running it. This is the story of the one test that could have saved the 1980s family farm and the 5 farmers who found out, too late or just in time, what it would have told them. The debt-to-asset ratio. Iowa, 1981. The debt-to-asset ratio is not complicated. You take everything you owe. You divide it by everything you own. If the number is above 40%, you are in the danger zone. If it is above 70%, you are one bad season from losing everything. In the late 1970s, most farmers didn't run this number. Their banks didn't ask for it. Their loan officers didn't require it. The government programs encouraging them to borrow never once mentioned it. A farmer named Gerald outside Cedar Falls, Iowa, had borrowed steadily through the 70s. Land, equipment, operating loans. Each time the bank approved him. Each time the land was worth more than he owed. In the fall of 1981, his extension agent sat across from him and showed him how to calculate his debt-to-asset ratio. The number came back at 74%. Gerald stared at it. "Nobody ever showed me that before," he said. The extension agent told him what it meant. That if land values fell by just 30%, his collateral would be worth less than his debt. Land values in Iowa fell 62% over the next 6 years. Gerald sold 2 parcels of ground that winter, voluntarily, at fair market value, and used the proceeds to pay down his operating loan. His debt-to-asset ratio dropped to 41%. He kept the farm. His neighbor, who never ran the number, was foreclosed on in 1984. The test existed. The information was available. Nobody had thought to make it mandatory. The break-even price calculation. Kansas, 1982. The break-even price calculation answers one question. What price does my crop need to reach for me to cover what it cost me to grow it? Seed, fertilizer, fuel, equipment, land payment, interest. Add it all up. Divide by expected bushels per acre. That number, that single number, tells you whether the market is your friend or your enemy before you plant a single seed. In 1982, corn needed to sell for around $3.10 a bushel. For most Iowa and Kansas farmers, to break even, the market was paying $2.60. A farmer who knew that number in March could make different decisions than one who found out in October. He could reduce his planted acres. He could negotiate his input costs. He could lock in a forward contract at a better price before the harvest time glut pushed prices lower. A Kansas wheat farmer named Dale ran his break-even calculation for the first time in 1982, taught to him by a neighbor who had done it for years. The number told him that at current prices, he was losing $47 on every acre he planted. Dale reduced his wheat acres by a third and planted the rest in grain sorghum, a crop with lower input costs and a domestic feed market, less vulnerable to the export collapse. He didn't get rich that year, but he didn't lose the farm either. The farmer who loses the farm is often not the one with the worst land or the worst luck. He is the one who planted 800 acres of something without ever calculating what he needed to get for it. The soil test. Illinois, 1983. Farmers have always had a tendency to over-fertilize. It is a reasonable instinct. More fertilizer means more yield. More yield means more income, except when the cost of the fertilizer is more than the value of the extra yield it produces. In the early 1980s, fertilizer was one of the largest input costs on a Midwest grain farm, and most farmers were applying more of it than their soil actually needed. A soil test costs a few dollars per acre. It tells you exactly what nutrients are already in your ground: nitrogen, phosphorus, potassium, and what you actually need to add. For many Illinois farmers, the results came back with a revelation. Their soil was already loaded with nutrients from years of heavy application. They could cut their fertilizer rates by 30%, sometimes more, and their yields would not drop. An Illinois farmer named Robert spent $180 on soil tests across his 600-acre operation in 1983. The results told him he was over-applying nitrogen on 400 of those acres. He cut his fertilizer bill by $11,000 that season. $11,000 from a $180 test. That money serviced 3 months of loan payments he had been scrambling to cover. The extension services had been recommending soil testing for years before the crisis hit. Most farmers hadn't done it, not because it was hard, not because it was expensive, because in the good years, $11,000 in wasted fertilizer felt like the cost of doing business. In 1983, it felt like survival. The interest rate stress test. Nebraska, 1979. A financial stress test asks one question: what happens to my operation if conditions get worse? Not catastrophically worse, just measurably, historically possible worse. What happens if land values drop 30%? What happens if corn prices fall to $2 a bushel? What happens if my interest rate doubles? In 1979, a Nebraska farmer named Walter signed a variable rate operating loan at 8%. Nobody at the bank asked him to stress test it. Nobody said, "Walter, what happens to your payments if this rate goes to 16% or 20%? Because in 1979, that seemed impossible. 2 years later, it wasn't. The Federal Reserve raised rates to 21.5%. Walter's loan payments nearly tripled. His land was worth less than what he'd borrowed against it. His corn wasn't covering his costs, and the debt he'd signed at 8% was consuming everything. A simple stress test, run with a pencil and a piece of paper, would have shown Walter in 1979 that his operation could not survive. An interest rate above 14%. He might have borrowed less. He might have chosen a fixed rate. He might have kept a cash reserve instead of reinvesting every dollar back into expansion. The stress test didn't require a computer. It didn't require an accountant. It required someone to ask the question that none of the men in suits at the bank thought to ask before Walter signed. What if things go wrong? The working capital test. Minnesota, 1984. Working capital is the money you have left over after you subtract what you owe in the short term from what you have available in the short term. Cash in the bank, crops in the bin, livestock ready to sell, minus operating loans due this year, minus input bills coming due. That number, that gap, is your ability to survive a bad year. An Iowa State University economist named Wendong Zhang later described the 1980s farm crisis as the failure of the safety net to run a stress test. In other words, nobody asked the question early enough. A Minnesota dairy farmer named Ruth had $280,000 in long-term debt on her farm in 1983. On paper, her debt-to-asset ratio was acceptable, but her working capital, the cash available to keep her operating day-to-day, was $4,200. $4,200 against a farm that needed $60,000 a year just to operate. When milk prices dropped in late 1983, Ruth had no buffer. She couldn't buy feed. She couldn't service the operating loan. She couldn't wait for prices to recover. A farm mediator who worked with Ruth later said that if she had known her working capital number 18 months earlier, if anyone had shown her what it meant, she could have taken steps to build it back up. Before the prices fell, she could have sold assets. She could have taken on off-farm income. She could have restructured the operating loan on her own terms instead of the bank's. Working capital isn't complicated to calculate. It takes 20 minutes and a bank statement. But in the 1980s, most farmers didn't know. It was the number that mattered most. They watched their land values. They watched their crop prices. They didn't watch the number that told them how many months they had left. 5 tests, none of them complicated, none of them expensive, all of them available in the 1980s. To any farmer willing to sit down with a pencil and a piece of paper. Debt-to-asset ratio, break-even price, soil test, interest rate stress test, working capital. Agricultural experts who lived through the crisis have said it directly since. Farmers have always had a tendency to over-fertilize, to over-borrow, to under-examine. The numbers beneath the surface of what they're doing, the ones who survived, were often the ones who simply looked at those numbers honestly, before the bank forced them to. The crisis wasn't caused by farmers being careless. It was caused by a system, banks, government programs, extension services, that never made these questions mandatory, that never said to a man signing a loan at a kitchen table in 1979, before you sign this, run the test. The tests existed. The question just wasn't being asked. New stories every week on Deep Furrow.